The distinction between book value and market value of a stock is basically one of looking back versus looking forward. Book value or accounting value is based on the company's historical financial results, looking back. You use a company's latest balance sheet to come up with the book value of the equity. You look up the number of shares outstanding, which is usually mentioned in the earnings per share calculation in the income statement, and when you divide the two numbers, you get the book value per share. Market value or economic value depends on the expectations of investors for the future of the company, looking forward. Do investors see sunshine and blue skies coming up, or clouds and thunderstorms? In order to form an opinion about the company's future, it is wise to dive into its strategy, technology, and leadership. Do these give you confidence that the company is on the right track? Next step is to try to translate that assessment to numbers. Based on the strategy, technology, and leadership, what do you see as the possible revenue, income, and cash flow for the company for the next 10 to 20 years? Last step is to review probability and variability. Do you think the projected revenue, income, and cash flow are pretty much a done deal, so the risk and volatility are low? Or is there a wide range of both positive and negative scenarios, so the risk and volatility are high? Let's go from the abstract to the practical and walk through an example of book value versus market value. To calculate the book value of the shares of Apple Inc., let's look back at their financial results. The latest balance sheet that I have available when making this video is the balance sheet of April 1st, 2017. Apple had assets of $335 billion and liabilities plus equity of $335 billion. To calculate the book value of one share of Apple stock, you take the book value of the equity, $134 billion, look up the number of shares outstanding, 5.3 billion units, and divide the two to get to a book value of approximately $25 per share. When investors make a decision to buy or sell shares of Apple, they look towards the future. It is, however, very well possible that not everyone has the same opinion about that future. The share price in early June 2017 is around $150. This means that some investors are ready to buy the share at $150 as they believe the future is bright and $150 per share is a good price to buy. And other investors are ready to sell the share at $150 as they believe the future for Apple is not so bright and $150 per share is a good price to sell. Now that we have both the book value per share as well as the market value per share, we can calculate the price to book ratio, which is sometimes called the market to book ratio. This is simply the market value divided by the book value. In the case of Apple, $150 per share market value divided by $25 per share book value, which gets you to a price to book ratio of 6. Does this number mean anything? Should you take action to buy or sell shares based on the price to book ratio? If the price to book ratio for a company is high, compared to historical levels, compared to the price to book ratio of other companies in general, or compared to the company's industry in particular, then investors are optimistic about the company's future. Is this optimism justified? Time will tell. If the price to book ratio for a company is low, compared to historical levels, compared to the price to book ratio of other companies in general, or compared to the company's industry in particular, then investors are pessimistic about the company's future. Is this pessimism justified? Time will tell. The most interesting situation is when the price to book ratio is below 1, which means that the market price that the stock is trading at is below the book value. This could mean that bad news is on the way. For example, upcoming write-offs of balance sheet items like goodwill of unsuccessful acquisitions, closure of sites due to overcapacity, or write-offs of uncollectible receivables, which would reduce the book value and return the price to book ratio to 1 or higher. It could also mean that other investors have not spotted that there's a bargain here, as they are trading a share for a price below what that share is worth on paper. In that case, the demand from investors spotting the bargain should drive up the price and return the price to book ratio to 1 or higher. Time will tell. As you can probably judge from my commentary here, I don't really use the price to book ratio as one of my main criteria in making stock market investment decisions. Speaking of the stock market,